Thanks everyone for waking up early and joining us here. Welcome to Austin Startup Week. Was anybody part of the Navy and Army hackathon this weekend? Anybody built some drones? One. You're still here? Still standing? Nice. That's awesome. It was really cool. You should look online. We had, I don't know, a couple hundred developers here hacking on the drones, really trying to prepare the military for that aspect of the future. But yeah, we're here for the fundraising track, and the fundraising track is co-hosted by Capital Factory and the Central Texas Angel Network. I'm Nick Spiller, head of investor relations at Capital Factory. For who's first time to Capital Factory today? Has anybody not been here before? Awesome, that's great. So I'm sure a lot of y'all have been here before too, but for those who don't know, Capital Factory, we strive to be the center of gravity for entrepreneurs in Texas. We operate a co-working space, an accelerator, and we're the most active venture capitalists in Texas for the last few years running. And today we've put on this series of panels and programming to really help entrepreneurs see around corners in the venture deal process. And I know just being part of Capital Factory and our fund and seeing we've already made probably 50 investments this year, and just seeing the way they go down. I was in startups for a long time, but not being at the table when one of these term sheets gets signed, there's actually a lot more that goes into it that I never knew about. And I think that's the purpose of the programming, is really to help you see what the investors do time and time again before you enter your first deal. Yeah, so I'm going to hand it over to my colleague Claire from the Central Texas Angel Network, and she'll tell you more about what she does, and we'll kick it off.
Hi there, thank you for being here. Kicking off the fundraising track first thing this morning on Monday. There are snacks and drinks in the back if you haven't gotten your coffee yet this morning. Again, my name is Claire Hansen. I'm the investment associate at the Central Texas Angel Network. We're one of the largest and most active angel networks in North America. We compete constantly for the #1 spot with actually the Houston Angel Network, just down south, our neighbors here. Let's see. You'll hear more from CTAN if you're sticking around for the panel at 11:15 on Raising from Angels. So you'll hear more from our members then, but this session is actually led by one of our members who is a managing partner at Wild Basin Ventures. Wild Basin Investments. I'll let her introduce herself. Here's Rosa McCormick. Thank you for being here.
Hello, good morning. Thank you guys for being here. As Claire said, I'm the managing partner of Wild Basin Investments here in town. We are an Austin-based investment firm. You can think of us mostly as an early stage venture capital firm, but we're actually non-traditionally structured. So we have more leeway in some of the time frame and stage of our investments. We've been around since 2007, and we've also been heavily involved with the Central Texas Angel Network. I sat on its board for a number of years, and my partner, Craig Harris, sits on its board now. I have given some version of this presentation to both investors and entrepreneurs, and I wanted to ask a couple of questions to sort of gauge the audience a little bit, so I don't either get too far into the weeds or get too far ahead of you guys. I'm assuming that this audience is mostly entrepreneurs. How many of you guys have raised a fundraising round, either debt or equity, before? Okay. And if I could see by a show of hands, how many people feel like they are very familiar with the terms for equity and debt fundraising? Okay. And how many people feel like they really don't know anything and want to sort of start from scratch? Okay. All right. Well, this, I'm going to walk through this, and if I use a term and I don't define it, and you don't know what it is, please, raise your hand and stop me. Also, this is a link to the presentation materials that are in a Google Drive folder. It's the slide deck and also the sample term sheet for reference, which I'm not going to be going over in the slide deck, but which you can refer to later. That is case sensitive. If you don't pay attention to the case of the letters, you will get to a Guardian article. So Okay. This is the presentation structure. I'm going to go over both equity rounds and convertible debt and also just give some general advice. So, you want to raise money from investors. There's the three most common ways to do it for early stage companies. One is a preferred equity round, convertible debt round, or a safe note. And generally when I talk about convertible debt, I'm also going to be talking about safe notes. They are not the same thing, but a lot of the concerns and details around a convertible debt also apply to a safe note, albeit in a different form. I always encourage people to first ask yourself if you really do want to raise money. And not all businesses should raise money at an early stage. You need to be realistic about your need for funds and whether or not you understand investor expectations, because once you have them, it's very hard to get rid of them. And also, I like to point out some businesses, depending on whether they have hard assets, can use debt instead of equity, and that can be a better situation for an entrepreneur. And the other thing to think about is what type of investor is a good fit for your business. Angels and VCs for a later stage, or certain types of companies, private equity might be a better choice, and friends and family often gets people started. So I'm gonna start with the preferred equity round because that has the most terms, is the most common if you're raising a sizable amount of money, and is generally what you hear people talk about for angels or VCs. That is a sale of ownership in the company. It's usually shares, or if you're an LLC, they're called units, but it's a piece of the company that's being sold for a certain amount of money. And it's almost always preferred in some way if you're talking about investors, and that means there's some preferential rights associated with it, and that's what you're negotiating in the terms most often. So you're going to set a valuation for the company in the terms, and there are a lot of documents associated with this. This means you need an attorney. Some people think they don't need an attorney. That is not the case. Even if an investor's attorney prepares the documents, you as an entrepreneur want an attorney, and you don't want any attorney. You want an attorney that is a venture capital attorney, because a lot of venture capital fundraising is knowing market and knowing how things go together. And if you're a real estate attorney, you just don't know that. And expect it to cost money. That's the other thing that's very painful. Convertible debt and safe instruments are quicker, easier, most appropriate for a smaller amount of money. They dodge a tricky question, which is the valuation of the company, but they assume that somebody is going to raise a subsequent equity round where a price is going to be set. So it really just delays the conversation. It doesn't dodge it altogether. If a company accumulates too much of these, it can really be a problem for subsequent fundraising. It has an effect on what that round looks like and can actually depress the valuation you receive for your company shares. So let's get into the terms. The preferred equity round term sheet is what you might receive from an investor. And it's a summary document that lists out all the terms, and it's where you do most of your negotiation. It speeds the syndicate formation, because if you have more than one investor, once you have a term sheet, other people can sign on to those terms instead of having a separate negotiation. And it allows you to get a lot of things out of the way before you get an attorney involved and pay them on an hourly basis. But it doesn't eliminate everything. There's always something that comes up and something that needs to be negotiated later. There are economic terms and governance terms, and there are terms that interact with both. So I like to think of a term sheet as a bunch of different knobs that you can turn in different directions. If you're having a disagreement over valuation, you might be able to fix it with another term. And if you're having a disagreement about control, you might be able to loosen control in one area and have more control in another, and have that suit everybody a little bit better. Another thing to realize is they are non-binding on the investor and on the entrepreneur, except for two things. One is confidentiality and the other is a no shop. And if you're an entrepreneur raising money and you're looking at different term sheets, once you sign a term sheet, you generally have a no-shop clause, so you can't talk to other investors. And so that's why I like to point that out, because that can, you need to decide whether you're through talking to investors and want to accept that deal before you sign a term sheet. Not before you receive a term sheet or negotiate it or think about it, but before you actually sign it. If you get a term sheet from an investor, you want to check the accuracy of the information they based it on, because their capitalization information or the information they have about your company is going to be what they base their deal on. So if they got something wrong, your deal may not hold. So that's one thing to make sure is clearly communicated, and if it hasn't been, to correct up front. Again, if you don't have company counsel and you get a term sheet from an investor, that would be the time to find one. Okay, how many people here have ever seen a cap chart? Okay. Then I'm going to assume that people understand how to read that and what that means about your company to a certain extent, and I'm going to go a little bit quickly through this. But the reason I try to at least make sure people understand this is that really, if you're an investor and you give people a term sheet, that's where you're starting in your understanding. You've gone through your due diligence, you think the company has good prospects, you think you can make a return. You need to understand where the ownership is and where your ownership is going to be afterward. So sometimes you see companies, and this is something, if you're an entrepreneur, to be really aware of. Have you promised equity to anybody where it's not on the cap chart yet? That might be outstanding convertible debt, but it also might be consultants or some sort of informal arrangement for options. And all of that needs to be reflected somehow on the cap chart so that you don't end up having an economic deal that gets pulled away by investors.
Do you have how a cap table looks?
Yeah, I have an extremely simplified version a little bit later, but basically what it is it lists, the equity shares or units, and it lists them by class. So if you have more than one class, you can see there's common stock, and there might be some other type of stock. And this is the headline everybody looks for, obviously the pre-money valuation. And from that, you determine your share price based on how many shares you have in your company. But this is what I like to point out to folks. Don't let that headline of the pre-money valuation distract from what is really the bottom line for investors and for entrepreneurs, which is you have your pre-money valuation and you sell some shares. And what that really means is then you have a post-money valuation. And your post-money valuation is what you calculate percentage ownership for entrepreneurs, for investors, and it really determines the exit value you need for a target return. If your investor wants a 5x, you have to think about what the post-money valuation is. So let me just go. I see some people looking at me a little confusedly. Your pre-money valuation is what you might get a term sheet that says, hey, we're going to give you $2 million on a $10 million pre-money valuation. If that happens, your company is actually worth $12 million, the 10 it was worth before the 2 million went in, plus the 2 million. And that 12 million is what you have to multiply by 5 if everybody was wanting a 5x exit. Option pools are also something you'll see in terms from investors. They'll usually want an option pool to be created before they put their money in. And that's dilution. At the time an option pool is created or an option pool is expanded, it is like another investor. Even if those options haven't been given out, it represents dilution, which is the reason that investors generally want you to do it before they put their money in, not after. If anybody had that link, and I can go back, you can pull up the term sheet and sort of follow along as we talk about these. Right now we're just sort of setting the stage with capitalization, but a lot of the economic terms are written in sort of legalese language in the term sheet, and that's why I provided an example. Sure. I've heard that discussed or floated. It's not standard at all. Normally, you're presuming that there will be several expansions of an option pool over the lifetime of the company. And so subsequent expansions, that dilution is spread across whoever is on the cap chart at the same time. I understand what you're saying. I'm not sure exactly how you would accomplish it, and you would probably get some resistance from investors. But he's correct. If you have only founders on a cap chart and set aside whatever amount for an option pool, then the founders are diluted by that amount. And if later those shares, which haven't been given out, disappear, then everybody's on the cap chart at that time gets their pro rata portion of those shares back, as it were. So your point is noted, but no, I have not ever seen anybody do a deal that encompassed that. So here's just a walkthrough of a very, very basic cap chart math. If you have 4 million pre-money and 1 million investment, you have 5 million post-money, and you've got an 80-20 split between common and investors on the post-money, because 20% of the company has been bought for $1 million. And that's another thing to think about. It is, people are buying part of the company. It's not being given away. People are purchasing it. And so there's an argument about price of that purchase, but it is a purchase. When you are looking at a term sheet of the economic terms, you know, these are the headlines. The price, which is determined by the pre-money valuation, liquidation preference, a dividend rate, anti-dilution protections, and preemptive rights. Now, the first two are the most important for an entrepreneur to think about in terms of how the ultimate, over the lifetime of a company and its fundraising, how returns will be distributed. A liquidation preference, in its most basic way, simply means that your investors are going to, on a liquidation, get their money back first. If they're putting up cash, they want to be the first people that get cash out, which is, I mean, seems pretty logical. It's normally expressed as a multiple of the purchase price, and if it's anything other than 1, then that is a little unusual in this market for an early stage company. It shouldn't be a 2x anything, except in certain circumstances. It's really most relevant in a downside situation, and depending on how rounds are constructed, preferences can stack. So if you have 3 rounds, it may, you know, you'll have a little flow chart of Series C gets their money back, then Series B, then Series A, and then participation by common. Or it can be written to where everybody participates together, all the preferred rounds, but I would say that that's not, unless there's a lot of overlap between who is in your different rounds, that probably won't happen. There's 3 general types, and participating preferred, again, is somewhat unusual now. It didn't used to be unusual, and it'll probably come back and forth.
Is it common the way you outlined it that C or B, like the latest typically has preference over the earliest?
Whoever puts their money in last wants to have their money out first, or else they wouldn't put the money in. So yes. So participating preferred is the most investor friendly. And that basically means that if the round was, in the case we just saw, $1 million, the investor would receive on a liquidation $1 million back, and then they would receive a share of the remaining proceeds based on their ownership of the company, which in that case was 80-20. So they would get $1 million and then 20% of the rest of the proceeds. A non-participating preferred means the investors choose. They either get their $1 million back, or they get 20% of the full proceeds. So the second, the non-participating preferred, truly is downside protection. Because if the company has less than $1 million to give the investors back, well, then the company has not done well, because it was a company that was valued at $5 million after the equity round. So this is not a good scenario for anybody. There's a sort of in-between version, which is where you're participating but up to a cap. And that means it acts just like participating preferred until you have a specified target return, and this will be greater than 1. This will be a 2 or a 3x. And at that point, once that return hurdle has been met, it switches back to the non-participating preferred. So on a an upside for the investors above the cap, it doesn't behave any differently. The most common for early stage companies, and I stress just early stage companies, would be the non-participating preferred. And that's and in general, early stage investors should try to stay as aligned as possible with the entrepreneurs, and that is the most aligning situation. It still provides downside protection for the investor, but it doesn't skew the returns on a percentage basis. Of these 3 types of liquidation preference, the only one where there is an upside difference in proceeds is the participating preferred. And the difference is a set dollar amount, which is the amount invested. So if you get $1 million back first and then you participate, no matter how much money is distributed, no matter how successful the company is, you will always have received $1 million more than your percentage ownership. Now, that can be a very small percentage swing in proceeds. So the larger the exit, the less difference it makes. I have a bunch of slides. They'd be better to look at if you pull them up and go over them, because I'm going to go through very quickly. But this is the non-participating preferred. And what you have is the orange solid line is what the entrepreneur is getting, and the dotted line is what the investors are getting. And so this is how much money there is to distribute. And so all of it, up into $1 million, goes to the investors. And then at that point, which is this point for the entrepreneur essentially catches up to where the investor would be, and then everything resets. So for the investor, there's a certain amount of proceeds under which they don't care on a downside. They're going to get their liquidation preference back, but above that amount, they're not going to receive any of that until they get over here. And that's something to keep in mind, because in that zone of indifference, there's a misalignment between investors or entrepreneurs pushing for more proceeds in an exit. The investors won't receive more proceeds because they haven't met the hurdle of their of converting. They've received their entire liquidation preference, but they have to wait to receive more preferences until there's a catch up by the entrepreneurs. And it's just, that's just a consequence of the structure. I'm not saying it's bad or good, but it's something to be aware of. And I'm going to flip through these. And this is showing all three of them together, basically. And you can see on a non-participating preferred, you have this zone of indifference. And on one with a 2x, there's another zone here. But at the end of the day, everything converges on an upside, except for the participating preferred, which maintains a set amount of extra, as it were, proceeds to the investor. And here you can see, this is showing that this was the last one was zoomed in here. If you get up to 8x in that example, there's a 2% difference in proceeds. So on a big upside, it really didn't make much difference. The other thing to keep in mind are dividends. Now, from an entrepreneur's perspective, you will almost always see a dividend, a preferential dividend to preferred shareholders, but oftentimes it's only if declared. Now, if you're a startup company, the likelihood of you paying a dividend to anybody is very low. So if your board is not going to pay a dividend to your common stockholders, they're not going to pay one to your preferred stockholders. So even though there is a dividend in there, if it's only when declared, it's probably not going to happen. Dividends can also accrue, and in that case, they sit there in the background, and they are a time-based return for investors. So they're another hurdle. Those get added to the liquidation preference. So a liquidation preference is, say, 1x plus any accrued dividends. And I think that it's really, for investors, a stylistic preference, whether they'd like to have a time-based return working in the background or whether they don't care that much about that. It will, if there is one as an early stage company, either all your subsequent investors are going to want it too, or the subsequent investors will make it go away. And a dilution protection, if you're looking at a term sheet, it should say broad-based. That's the middle of the road. And basically that means is if you have a down round, everybody shares via a formula in the effect of that, and the investors have a bit of protection. And I misspelled effective. Okay. Preemptive rights, that's a right for an investor to keep participating, so they can keep their ownership of the company if they are able to keep participating. These can get expensive for investors depending on how successful your company is. Yes? Right. The definition of a down round, usually in the documents, is that you're selling shares at a share price that's lower than you sold them before. And so that might happen because of option pools. Like if you did one round and then very quickly did another round, you could have the same valuation, but if there's been dilution, you'll have a technical down round. It's also the reason you want to avoid these if at all possible as entrepreneurs, because they're really destructive for everybody concerned. So when you do an equity round, it is better to have a reasonable valuation that you know you can grow the company and exceed on the next equity round than to get a really good price now and then have a down round later, because the down round later will not be good for the entrepreneurs. It will misalign the investors. It's more destructive than it would seem mathematically. So it happens, and sometimes it's a reset, and that can be the best thing for the company. Sometimes companies need to have a down round, or they're not going to be able to raise subsequent money. But don't get so excited by having a high valuation that when you look at the post money, you can't get a higher share price the next time from an investor, because that will not be to your long-term benefit. Yes.
How would you recommend entrepreneurs to balance the relationship with investors so they're not sending off vague signals about their ability to make it successful, at the same time they want to protect themselves?
I think it's a negotiation amongst interests, and everybody needs to oh, sure. His question was, how does an entrepreneur send out the right signals to an investor to where they're protecting themselves and their interests, but they're also getting along with the investors? Is that okay? And both sides have to understand that there are legitimate interests. And so investors have interest in having a financial return and in having control over their investments and in having information. And investors have legitimate interest in retaining control over the outcome of their company's growth and dilution. And so trying to know what market is and be realistic about valuation, while at the same time trying to understand how to keep enough control and economic benefit in your company to keep you motivated throughout what is going to be difficult. For some people, control is more important than upfront dilution, and for some people, it's the opposite. Some entrepreneurs have what is an unrealistic expectation of what their company is worth, and that's bad news, because investors have to feel that they'll make a profit, and if they're not going to feel they'll make a profit, they won't put their money in. So stepping away from economics, there's also governance terms, and the biggest one here up at top is board composition. And then we'll get a little bit more into the nitty-gritty. Board composition is, who's on your board. And so it's a democracy in your board. So if you're outvoted by the investors, you can be outvoted. And if the investors are outvoted by the entrepreneurs, they can be outvoted. And since those two groups have differing interests sometimes, it's generally structured to be a tie with a outside tiebreaker. So if you have a 3-person board, it's usually 1 common, 1 preferred, and 1 independent. Make sure that person is independent, actually. And 2-2-1 is a 5-person board. As an entrepreneur, you want to make sure you are represented on the board from your class of stock, not only by whoever the CEO is usually on the board, but also by somebody else who will be a competent board member on behalf of the common. So you don't want another common board member just because. You want somebody who's going to do the work and understand what it is to be a board member. So the board has a legal decision-making control and oversight of the company, which doesn't mean they manage it on a day-to-day basis, but they can hire and fire the CEO, and that's their basic job. If the CEO is not able to make the company a success, the board, in its fiduciary duty, would need to look into that, either get the CEO what they needed for assistance, either in personnel or other resources, or to change the CEO. And when you take on an investor as an entrepreneur CEO, you are implicitly saying, I am going to do this job for you, and if I'm not, I know that I may be fired from that job because I am not able to do the job I promised to do. Probably. Is there a fiduciary? I don't know. Is there a fiduciary duty to the statement of purpose? Yeah. Yeah. That may be, and you're probably right about that. So all shareholders, all board members have a fiduciary duty to all shareholders. And this is something that is hard to negotiate, both for entrepreneurs and investors sometimes. But understanding up front the mental position that a board member should have would be helpful to remind your investors sometimes, and be helpful to remind yourself sometimes. So there's also in a term sheet, there are matters that are essentially legislated that the board must review and vote on. These are protective provisions for the company, things like taking on debt, binding the company to a certain exit scenario. Sometimes, and this is something to pay attention to, there are director-specific votes. They'll say, well, the board needs to approve executive compensation, but that approval has to also include an investor. Or that's a common one, to try to put an extra layer of governance. And this will tell you that different investors feel differently about things that should be voted on, or thresholds. And it also matters what is your company doing. If your board has to vote on every issuance of debt over $25K, and you have a business that routinely, or any liability over $25K, and you have a business that routinely does that as a course of business, you need to make sure you negotiate that so that you're not going to your board every 5 seconds, because it's not going to be particularly useful for anybody. Protective provisions are kind of like the board voting, only they're voting for shareholders. And you will see a lot of these for preferred shareholders. That preferred shareholders at some threshold, either 50% or 2/3 of the shares in those classes have to vote for, it's usually a liquidation, or sometimes it is, again, in the issuance of debt at a higher amount. And you'll see that you have to go actually back to all of your shareholders, not just your board member, before you can take that action. There are also thresholds for common stock, and that as an entrepreneur, you should take a look at that. You're probably, the majority or the founders together are a majority of the common stock, and it can be written into the documents that certain actions can't be taken without a majority of common stock voting. And so when you're looking at a term sheet and you see when you need to go back to your preferred shareholders, also think about when people should have to go back and get a separate vote for common stock shareholders, because you don't want that voting threshold to be ignored. And this is one of them where it really matters for an entrepreneur, and this is called a drag-along right. And you want this in your documents because you don't want actions by the corporation to be held up by one dissenting shareholder. Maybe it's somebody who was an employee and exercised some options and went away. Maybe it's, one member of the founding team that disagrees with other founders. Maybe it's a small preferred stockholder. This basically says if most other people are wanting to take an action, you're going to have to come along. However, there is also usually a drag-along provision that says, look, if all the preferred stockholders and the board vote to take an exit, then common stockholders need to come along, and that can include the founder. And there are reasons why an investor would want this. If they want to exit a company and they have a good offer, and the founder says, no, I want to run the company forever, then you obviously have a mismatch of incentives, and they want to be able to force that founder to come along. Now, on a practical basis, it's very hard to sell a company when the CEO is not cooperating. So this only goes so far. But you could have one founder not cooperating and other founders cooperating. So you think about what it takes to drag the founders when you see that. What is it? And that is a set of things. It's usually not just the preferred stock said so. You usually also have the board having to be involved.
So earlier we were talking about a 2-2-1 person independent. So where does that person come from?
Yeah. Yes, he was referring back to the board composition, and there's independent directors, and how do people decide on the independent directors? Who are these people? And they're usually via either all the shareholders need to agree on them in some way, or what's more practical is to say once you have your board that has common and preferred, those board members need to mutually agree on. So it's a mutually agreed on person. Oftentimes term sheets will say they can't be an employee, they can't be a shareholder. In other words, they have to really be disconnected from the company. And you want somebody who can be helpful. So entrepreneurs sometimes just don't get around to filling this spot. I would encourage people to fill the spot because it's great to have an outside perspective. You do want to pay attention to who that person is and make an explicit agreement with them. I want you on my board because of this skill set. And pick somebody who can be helpful to your business overall. And investors should want that, and they should want to help you find the person as well, because they may have connections or knowledge that the company needs.
What is the incentive for the independent board member
Usually they're compensated with options.
Normally, like in larger companies, it happens that the CEO in some ways controls the board in that, they select people that will go along with their strategy or their vision, and the independent directors almost become like puppets of the CEO. How does this happen in this early stage, or what are your thoughts on that?
That can happen. I think that until, I was encouraging people to fill the independent spot, but if your companies are at a really early stage, you may not be able to attract the quality of independent board member that you would want to have later. Have service limits. People shouldn't serve forever. Your investor board members theoretically serve forever, but your independent board members shouldn't serve forever. And that was a badly, if they're really just a puppet of one side or the other, then that was a badly selected independent board member. There is a tension between, you compensate with options, so they may not start out a shareholder, but they become a shareholder. And so that can, usually it's not a giant amount of shareholding, but that can become an issue. If we want a real life example of that, you can look at what's happening in the research medical hospital. Sloan Kettering, for instance, has had trouble with its employees sitting on the boards of companies that Sloan is partnered with or invested in, and then you have a appearance of a mismatch of incentives. Information rights should be enumerated in a term sheet. What is the minimum? This is the minimum information, folks. You should always respond to your investors' questions because that's just smart. But what are the minimum requirements? What information would your investors like and on what time frame? And it usually has to do with financials and cap table. This also provides a deadline for you as an entrepreneur to get stuff out to your investors. Be professional. If you can't provide quarterly financials, something's wrong. Now, this is a big one for entrepreneurs. This is a very big point of contention. And what this is essentially talking about is reverse vesting. So if you're an entrepreneur and you own, let's say there's two founders, they own 50-50 the company, and they're going to take in an investment round, and they know they're going to sell a portion of their company, but the investors also come to them and say, okay, I know you're going to own 40% of the company after the round, but I want you to subject some of that stock to a restricted stock agreement, which means that you don't own it outright any longer. Some portion of that is going to vest over time. So it's not that you won't ever get it back, but you will only get it back, there'll be a 1-year cliff and then monthly vesting thereafter. And it should not be all of the stock, by the way. It should be a portion of the stock. And that is a huge point of contention. The schedule of vesting and the fact that it's happening at all and to what extent. And why do people want that? They want it for a couple reasons. Number one, they want you to stick around if things get really hard. They want you to say, hey, you got to stick around in order to get this stock back. The second thing is, to be blunt, if things don't work out and you turn out to be a terrible CEO and they have to hire somebody else, they need some portion of the company back so they can give it to the new CEO, because the CEO won't work for it either, otherwise, or they'll have to dilute themselves. And, go ahead. I think it really depends on how it's negotiated. This doesn't always happen by any stretch of the imagination. I think it's more likely to happen when an entrepreneur is not a experienced CEO. That's when the danger. If an entrepreneur has had several successful companies before, it's hard to make an argument that they're not going to be a competent CEO and you're going to need to hire somebody else. And hiring somebody else in this reverse vesting doesn't always mean that the founder is fired. It might mean we've got to give compensation to somebody who comes in as another executive. But that's a whole other negotiation, because that won't be laid out in the restricted stock agreement. If it happens, I would say between 25 and 50%. It depends on the investor, and it depends on the experience of the entrepreneur. Because it's a hedge on the part of the investors that growing a company is something that's within the capabilities of the entrepreneur.
So this would be the case where it looks like that you're an investor and you don't know about a certain technology, and that's, the founders have that technology, and suddenly they might just walk away, and then your investment goes with it.
Okay, his question was entrepreneurs know about a certain technology and they might just walk away and take it somewhere else. That's one thing that this might help with, but what's really going to help with that is, and it's not even on my terms, but you will be asked as an entrepreneur to sign over the IP and the inventions to the company. So that's what prevents that. I mean, knowledge may leave, but you don't want the situation, and for founders with multiple founders, think about it this way. If you got 3 founders and somebody has a life event or has a change of heart, do you want your co-founder walking with the entirety of their stock while you get to stay on in the company and make it work for them? So that is, as painful as it is to reverse vest some of your stock, if you have multiple founders, that's also an insurance policy for teamwork, as it were. You don't want somebody to leave, take all their stock, and you spend the next 8 years of your life working to make it worth something for the person who's done something different. Okay, this is obviously a fear. Okay, this is what everybody's worried about. Okay, there are probably somewhere out there in the world people who would do that. And let me tell you something. It is a real pain in the butt to remove a CEO, find somebody else, and in the meantime, try to keep the business together and not from falling flat on its face. It is not something that is fun. And so this is less of a problem than you would think, especially in an early stage company. An investor doesn't know where the bodies are buried in the company. They don't have the relationship with the team. They don't have the relationship with the customers. They've got to really think that the company is going to explode if they don't take an action. And even then, it's a political nightmare to even take that action. So it's not that easy. Not on a document basis and not on a practical basis, that's for sure. That being said, make sure you know what the expectations are of any investor. And this has to do with returns And it has to do with performance and how you're gonna, I mean, you want to make sure that you've got somebody you're gonna work with. That doesn't mean they're gonna always see it your way, or you're always gonna see it their way, but having some idea, what are you expected to do? If you're expected to do X and you do Y, people are gonna be upset.
You didn't cover the acceleration terms, isn't that part of the protection?
That's right. Okay, so one thing that can happen, if your stock is reverse vested and somebody buys your company, great outcome, right? Well, you want to try to have a double trigger acceleration on that reverse vested stock. And that is an appropriate protection for a founder. If you have made a, if you have a successful company and you still have 20% of your stock left to vest and you take a quick exit and it's a great outcome for everybody, the next investor is the one I would worry about taking your stock away, the acquirer, rather than your investors. So what they do is they put in called double trigger acceleration, which is basically if the company gets bought and you get fired, or you get demoted to mailroom, you get all your stock.
For multiple founders, is reverse vesting the only option? So let's say one of the other founders does have a life event and they have to leave. Is that the only option for them to not walk away with,
Sometimes there's agreements between founders. Investors will look a little bit askance at that or want to be involved in setting the terms of that so they understand. There's also, you could write in things about buying stock back at a certain price, or having another way to recover that. But in general, if you have a reverse vesting agreement and it says that if you were to pass away, your family doesn't get any of your stock or something, generally people object to that. So it can get into really contentious areas. That being said, I guess what I try to, everything's negotiation, but there are legitimate reasons an investor wants it, and there are legitimate reasons founders want it for other founders. And so just keeping that in mind and kind of come to something everybody can agree with is good. Okay, this is, just real quick, there's things called conditions to close in the term sheet. This will tell you what people are worried about, read them. If there's something unique in there, which there probably is for every deal, understand what those are and don't let it be a hindrance to you. And this sort of speaks to a question earlier. Here's some, people are balancing interests. So here's some founder concerns. We all can probably look at that and know how that interacts with the terms. And there's some investor concerns. The term sheet and all the terms work together to try to balance those interests and concerns. And some investors are really, really, really worried about preemptive rights, investing in winners. And some are less worried about it. And some founders are very, very worried about reverse vesting, and others aren't. So each deal takes on a little bit different negotiation tenor because everybody has puts different emphasis on things. So when you turn the dials in the term sheet, just think about what dial you're turning, and you can turn one up and one down, like founder vesting, option pool, how much of it, pre-money, the size of the round. That all tells you what your ownership is at the end of the day. And this is about return. So if you're worried about, if the investor wants a liquidation preference you don't like, maybe you can trade that and say, why don't you have a dividend instead that accrues, but it's at a reasonable level. People might take that trade. This is about control. So all of this control, ownership, and economic return are all dials that are being turned in the term sheet. Now, I'm going to switch gears here so we have time. I'm going to do this quicker, and it can be done more quickly than the other. Convertible debt. So if you are an early stage company and you're not raising, let's say you're raising less than $500,000, $800,000, this might be the way you want to go. And it is a debt instrument that gives the note holders the right to become an equity holder under a certain set of circumstances. And those certain set of circumstances are the things to pay attention to. It's unsecured usually, can be secured. Yeah. It's going to be, where that line is depends on investor preference, stage of the company, probably whether or not you have a lead investor or not. Sometimes convertible debt rounds are used because you're having a rolling close. You're taking in small amounts of money over a certain period of time, which is kind of a pain for the entrepreneurs, or you're in constant fundraising mode. So I'm not necessarily recommending it, but sometimes people do it because they say, hey, I may need 250 or I may need 450 to get to my next point where I do want to raise my round. I don't want to take in 450. I want to take in 250 and then raise the rest if I need it. Don't raise more money than you need as a really early. I'm assuming everybody's very early stage. Like, just be frugal, because all of that really affects your ultimate ownership in the end. Especially if you get too much debt on your books, it just really messes things up. But convertible debt is efficient. It's efficient in terms of how much paperwork there is, how much legal bills you end up paying, and it avoids the biggest contentious question. Well, it avoids most of the really contentious questions, but especially avoids having to set a valuation. However, keep in mind that somebody is ultimately going to set a valuation. So it's kicking the can down the road, but you're not avoiding this question. It also, to that point, assumes an equity round. So if you were not planning on immediately figuring out how you're going to raise an equity round, this is going to be a problem, because it needs an equity round to convert. And if it doesn't convert, or it doesn't have the right equity round, then you just owe people a lot of money. So, and you can't fundraise on top of that without taking care of that little issue. The amount of convertible debt you can raise really depends on how large your subsequent round is going to be. So if you're a company that knows they're going to raise a $10 million round, you can take in a lot more convertible debt than if you think your next round is going to be $3 million. So often there's no formal term sheet, although there can be. And so that's what it looks like when people, that's the term sheet right there. We're raising $400K of convertible debt with 6% interest, a 15% discount, and a $6 million cap.
How does the discount apply?
I'll get to that. So interest rate, self-explanatory. Term, how long, is the note before you have to pay it back? I would, if you can get 2 years, get 2 years. Sometimes an investor is not interested in more than 18 months, but 2 years is a good thing from a company perspective. There's a discount, which basically means I have a coupon off the share price into the next equity round. So 15% discount, 20% discount, those are generally what you're looking at, one of those. If your equity round is really close and in process, the discount might be less. So if you're taking in convertible debt because you're just in the final terms, final stages of negotiating a term sheet with a credible investor, you may be able to convince people to take much less of a discount. So the farther away your equity round is, the more discount people are going to want, because they want to be compensated for the time their money is being used without it being equity. The other part of it is the valuation cap. And so in addition to getting your coupon, your discount on the next share price, oftentimes you want to, as an investor, hedge against there being a runaway valuation. So the company's going to take your money in, it's going to use that money to become successful, and if you think that there's a possibility that they're going to become so successful that you really won't have been properly compensated for the use of your money, then you'll want a valuation cap. And that basically says you take that amount, whatever the valuation cap is, and you divide it by whatever the capitalization of the company is at the time there's an equity round, and that's the maximum share price you will pay. So if this is set too low, it really messes things up in a way, because that means that the discount the investor receives can be huge, and generally the investors at that time do not like that, and they may say, I'm sorry, but you have to do something slightly different. However, it is, I would say, mostly a term I see almost always in a convertible debt round. So just, think about this. A lot of times it won't have much effect at all, but you don't want it to be too low, and if it's too high, it won't, too high is not bad for the company necessarily. Just don't peg in your mind that that's the valuation you're going to get at the next round. If you can get people to agree to a high cap, that doesn't mean you're getting that as a pre-money valuation. That just means that your cap isn't going to come into play. And this is one thing that oftentimes people don't understand, which is if you have a cap, that doesn't mean that when you get to a pre-money valuation of that amount, that's when the cap comes into play. It's at a valuation north of that by the ratio of your discount, because you take either the discount or the cap. Well, if your friends and family are investing through a convertible note, they can have a cap. It's a matter of the instrument. A lot of times, friends and family will invest more informally, but there's dangers in that too. I actually would advise entrepreneurs, if you're having friends and family around, treat them like an investor. Have all the documentation. And make sure everybody understands what the deal is. Make sure, don't get too good of terms from your family and friends, and don't give them too good of terms either, because that'll mess things up. So yeah, really, it's hard to set a cap really, really super early, like I'm in my garage with some graph paper and a pencil type of early, because you may just be wildly off the mark. Okay, conversion. The convertible note, the nitty-gritty is, when does it convert and when does it not? You have a qualified financing, sometimes it's called something slightly different, but basically that says if you get that amount of money in an equity round, automatically your note holders can convert. There's no argument, there's no anything. You look at the terms of the note, do they get a discount, do they get a cap, whatever, it converts in, you're done. But what happens if you can't raise quite that amount of money? That's a non-qualified financing, and you're going to have to ask people whether they want to convert. And so if it's a good deal for the investors, they might say yes, but if it's just, a tiny amount of money that you found somebody to give you, they're probably going to say no. But a well-written note should cover all the eventualities. So raising money, either a lot or a little, is one. But your company could also have other things happen to it. Nothing could happen. And then it comes due, that's the term. But you could also have acquisition and bankruptcy and the company wanting to retire the note with other debt. And so all of these things should be covered in the term sheet. Bankruptcy is, okay, you've gone into default, we're going to try to collect our money. Everybody kind of understands that one. In an acquisition scenario, you can have a couple of things happen. You can have a predetermined amount of valuation that the note converts into equity at. It's usually low. It's usually, if you haven't managed to raise money, that means my valuation should be low. And it can also say on the upside that if you get a quick acquisition, I want a certain guaranteed return on my note investment. So you'll see, depending on the risk, you'll see everything from like 1.2x up to like 2.5, 3x, depending on exactly how risky the money is. In a normal note, when you're going to raise equity and there's nothing strange going on, you'll see it around in the 1.5 range. Here's the other thing that entrepreneurs and investors should think about from an entrepreneur's perspective. Who is majority in interest? Majority in interest are the people who own more than 50% usually of your note. And those are the people who control the note. And so you want to know who that person is or who those people working together are, because they're going to make decisions about how that note is enforced, whether or not it can be extended, or any other questions. And so you want to know who you're dealing with. Those people have a lot of power in certain circumstances. One other, some investors don't like this, but there's a thing called an overhang issue. And if you're a company, try to get that into your convertible notes. And basically that means that when the convertible notes convert with a discount, they've got to do so into a different class of stock than the other investors so that they don't have a liquidation preference that already has a return on it, which is the amount of the discount. And your subsequent investors will want to see that. Some investors will not put that into a note, so it just depends on how people feel. This is one note of something not to do. Don't take in a bunch of notes and then change the terms around a lot and have different terms so that some people have one discount and one cap and other people have one discount and different discount and another cap. There are rational reasons to change that depending on the changed risk circumstances or time frame. But what you want to make sure is you don't have person A and person B with arbitrary different terms, and that you're going to have to go back and figure this out when you raise an equity round. If just because somebody's asking you for a different term, you may have to say, no, because I've given everybody else this term, and I can't, unless you've got a rational economic reason why it should change, we need to keep everything the same. Okay, let me go through this really quick so I can answer questions. Be super responsive to people's questions. And if you're trying to raise around any momentum you get, any fear of missing out, that's constant drumbeat of information. And I don't mean harassing people. I mean relevant information, keeping people up to date, and letting people know when you're having success can build momentum. Don't get cute with terms, and don't let anybody get cute with you with terms. You don't want to provide impediments to future rounds. Oh, that is fear of missing out. So, sorry. The fear of missing out, if people say, oh, I better get into the round now, it's going to be all gone, or so-and-so's getting into the round, that must mean it's really cool. I mean, that really, that works. That even works on people it shouldn't work on. So. It really does. But now you don't want to be too obnoxious about it. But you know, keeping that sense of scarcity really helps an entrepreneur raise money. Be careful who you raise money from. If you have a few inexperienced investors on your cap chart, that's probably fine. But don't have a cap chart full of inexperienced investors. It's just going to be extremely annoying when you have an experienced investor that wants to come in and invest, because there's going to be questions and difficulties, and it's not going to look attractive. It's going to look like a pain. And this is maintain good investor relations. Just tell people what's going on. Be transparent. People ask you for some stupid piece of information. Just give them the stupid piece of information. This will serve you well in the long run. And understand what deal you're getting into. That sounds like a good rule. That's right, yeah. And that's actually, now oftentimes there's a bad actor clause. Yeah, and you can put them in too. They have to certify that they're not anybody's list of annoying, bad, unethical people. And you don't want one of those people on your cap chart. Okay.
Yeah, just wondering about safe versus convertible debt. Any suggestions on when you should offer one or the other?
I am biased against safe notes, and I'll tell you why. One is that I think you have to work really hard to get into them, the things I like to see as an investor. However, they are really quick, and so if you're just raising a little bit of money, and people will accept that and understand that, it's not a bad strategy. Just so people know, safe notes, it is not debt. It is an agreement for, it's called a simple agreement for future equity. So it is a, you know, an option on future equity under circumstances. The safe notes can also be dangerous for entrepreneurs because it's not sort of wrapped in one facility. So things can kind of get away from you. You can look back and say, you know, gosh, I sure have a lot of safe notes out there. And that's not going to be good for me when I'm raising an equity round. So if you are doing it, really keep track of it. And again, keep track of variation in terms, because someday they come into effect.
What are your thoughts on software platforms like Carta and things like that?
Love Carta. And there's a competitor too. I'm not, yeah. He said, what's your thought on software platforms like Carta? That's cap table management software. It also allows you to do board consents, keep track of things you need to keep track of. It's just like any software, you know, garbage in, garbage out. So you have to have somebody putting the stuff in on a regular basis accurately, okay? So it's not a substitute for auditing that with actual documentation, but wow, it makes it easier. Way better. And they have great downloaded, you know, I use it all the time now. I'm just like, I've built a ton of pro forma, you know, capitalization tables and round, you know, waterfalls, but it's great to just already have the information in there. You download them. It's great. Any other questions? Is there, go ahead.
How often do you see, like, or do investors ask for, like, MFN, most favored nation clauses?
In a note, yeah. Yeah. He's asking about an MFN, which is a most favored nation clause. And that means basically the deal you made with me, if you make a better deal for me with somebody tomorrow or next month, I have the option of getting that deal. So this comes into play on an investor side. If you have a convertible note and they put their money in their convertible note, and then later you negotiate with somebody and they want a higher discount, some people will just go back and give the former note holders the same terms. That's just a sort of a choice on the part of the entrepreneur to treat everybody the same, but it can actually be written into a note that says you have to do that, or you have to give the options. The other way it comes into play is in sometimes with strategic investors and what they want. But normally for this purpose, it's a rational thing to put in, depending on for an investor to put in.
Before we wrap up, go back to your first slide that had the Google link to the materials for folks. I see a lot of folks doing it.
Yeah, and I put this slide deck up in a Google Drive and the term sheet that you can just read over and see how these things actually get written out. And again, this is a link that is case sensitive. Yep, there we go. So, yeah. Anybody have a term that they've heard about? And I did not put all the possible terms in here. Things that weren't covered are things like redemption rights, different ways of writing preemptive rights. Okay, common mistakes. Do not form your company off of LegalZoom and then expect it to work out. Like, actually go to an attorney. Just make sure you've got everything, and then keep track of things. And this also means any agreement, written, verbal, or implied with somebody about equity. I would try to keep as many people off your cap chart as possible in the early stages, and I don't have a bunch of equity owners. If you have convertible debt that will turn into equity, that's one thing. But if you have a bunch of random people who have common shares and people aren't exactly sure why, that can just be a question mark. Definitely anybody who works for your company and does anything for your company, get them to sign an agreement so that their work product is the company's work product. That is also a thing that can really be difficult. And if you're taking money from friends and family, just make it formal. That's not the time to be informal. It's not to your advantage to be informal either. It can cause all sorts of personal problems.
If you're starting a company in terms of fundraising, future fundraising, would you prefer an LLC or an S corp? Is there any advantage?
Okay, the question is, do investors prefer an LLC or an S corp?
What would be better for the founder so that he can raise
If you're talking VC, if you think you're going to raise an institutional VC round, at some point people are most likely going to want you to be a C corp. There are theoretically some tax advantages, LLCs or S corps, which have been lessened now that the corporate tax rate has gone down. It used to be a matter of double taxation, but it's not that people won't invest in an LLC, but it's not as standard if you're in the venture capital world. In other types of investing, it's actually preferred. Is this an institutional investor or an individual? Okay. If it's an institutional investor in another country, I think it depends on which country. I think you can do due diligence on, say, a European VC firm the same way you would do due diligence on an American VC firm. If it's in a country where you don't have network, I think you have to talk to portfolio companies. You want to talk to, if they've invested in other entrepreneurial companies, if at all possible. And this goes for U.S. firms or an investor or an angel investor. It's fair game to say, I'd like to talk to somebody else you've invested in. Does that help? Or is this, you can talk to me afterwards if there's some special circumstances, but sovereign wealth funds, very hard to deal with, just in my experience. Yeah, if they're an institutional fund, there'll be some sort of regulatory agency that has some sort of jurisdiction over them in their home country. You mean for entrepreneurs? If you are Elon Musk, you might be able to do that, or if you are, that hasn't worked out. That didn't work out very well for some of even the rock star CEOs and companies that are later stage VC. It ended up being a governance issue. Outside voting rights, I think, are the purview of companies that have such huge economic prospects and such key founder or experienced entrepreneurs that they can make that argument. It's just, it's bad governance, if you ask me. I think about governance as mutually assured destruction. You want everybody to need to work with everybody, or it be bad for everybody. If I will say to this point, now I don't know exactly what circumstance you're talking about, but if you're an entrepreneur and a founder and you want to maintain complete control over your company, do not take in money from investors. That is not what you want to do. just don't. Figure out another way to form your business. Don't do that, because otherwise, people have a legitimate interest if they give you their money in having some idea of what's going on and some at least partial say in things. So if you want 100% control, you know, mortgage your house and, you know, get some money from a bank. I mean, yeah.
Can you talk a little bit about your company, what kind of investment you do, technology?
Actually, tell them more about wild basic.
Yeah.
It should be on.
Test, test. Test.